Hello and welcome to Funded Futures. My name is Emily. I'm your host, and today I've got a very exciting guest. It is Steve Maarbani, who is the CEO of VentureCrowd. Steve is an ex-lawyer turned venture entrepreneur, fundraising genius. Welcome to the podcast.
It's great to be here. Thanks for having me, Emily.
How was the intro?
The intro was great. I really liked it. Yeah.
Yeah, you looked excited.
Deviated slightly from the bio we agreed, but that's cool.
Yeah, well, I always will. And if you believe what I'm selling, that's your problem, not mine. So let's start from the beginning. Why did you decide to abandon law and go and create the massive, I want to say, like, it's a digital phenomenon now that is VentureCrowd?
Yeah, the first thing I want to say is I didn't create it. This is a massive, massive team effort. But where it started was I'm a corporate lawyer by training. I was a partner at PwC. And when I was at PwC, I used to run the venture capital practice. So in that role, I spent time working on the establishment of many of the VC funds around the country that you might know, working with those fund managers on their due diligence processes and then their investments and establishing their funds.
Yeah.
I was also on the management committee of Sydney Angels. So I worked with lots and lots and lots of angel syndicates on heaps of deals, everything from deal assessment through to due diligence through to the transactions themselves. And the other part of my practice was working for the founders and the companies that were looking to raise money for obvious reasons. They came to me because of the connection with VC funds and also other investors. And so I've worked on both sides of the private capital market transactions. My entire career has been in that space. And I found it, and I'm pretty sure I'm not alone here, very, very, very frustrating. So we formed a view very early that the private capital markets are highly inefficient. It sounds like a contentious statement, but actually I think it's just a fact. If you were to Google what creates market inefficiency, you'll get a list of elements which basically describe the private capital markets. They're fragmented, they lack transparency, information asymmetry, hard to get into, expensive, driven by irrational market psychology and all these other things. And you just go, hang on, that's the private capital market. So I think to say the private capital markets are inefficient, they were when we started and they still are now, I don't think is a contentious statement. I think it's a fact. And that inefficiency was creating some really disappointing outcomes, right? It's harder for founders to raise capital, do the great work that they need to do, solve major problems, create jobs, create the industries of the future and create wealth for everybody at the same time. And it's hard for investors to get into those asset classes as well. So that inefficiency wasn't working for either side of the twin-sided marketplace. And we kind of felt that this is not a supply problem, right? There's lots of private capital out there. There are hundreds of thousands of people who want to participate in these kinds of markets, but they simply can't. What's missing is the connection, right? A seamless and efficient connection between the true universe of issuers and the true universe of investors. And we believe that that could be done digitally.
Okay.
So that was kind of where it started. So we thought, well, what if we could digitize the process of raising capital originally in venture capital? Because that was my background and that was my co-founder's background as well. And then from there, it's just kind of built from there.
You make it sound so simple.
Yeah, I mean, it's definitely wasn't simple. Like you should have seen the first version of the website, right? Like none of us were technology people, none of us. We just had this idea. And we're like, what if we took the deal flow that we're working on and then put it on a website and then promote that to our network? Would people then, bypass what was traditionally accepted to be the only way you could do due diligence into a startup? Go to pitch nights and go to demo days and become part of a syndicate and do the full review of the data room and all that stuff, eyeball the founder and meet the team and go and visit the premises and all that stuff. Would they bypass that and invest digitally if certain things were in place?
Yeah.
That's what we were testing, right? Because everybody said, this is a really bad idea. This is not the way to raise venture capital. Nobody should invest in startups like this. It's flawed for all of these reasons. But those reasons tended to be anchored in these sort of legacy processes that I and my partners just believed were archaic and needed to change.
Right.
So we were testing an assumption, and we weren't technologists. The UX was crap, but we got some deals that we had done DD on, had some capacity in them, put them on the website, distributed them to our network really clunkily, right? Like we didn't have social media tools that we have today.
Yeah.
And people began to deploy capital in completely digitally. And we're like, well, hang on, there is a world in which, in addition to the traditional sources of VC, angel groups, family offices, institutional and corporate investors, and grant funding, there's a whole nother group of people who would participate if they were given access in a seamless way with the right amount of information to make an informed decision.
Right.
And then we're like, there's something in this. Yeah.
And also, at the end of the day, time is money. Isn't this more efficient than going and having endless coffees with people trying to sell them on your company and get that investment? Whereas you can access a whole range of potential investors, and vice versa. You've got the access to all of these founders and businesses that you might not have ever heard of if you're an investor.
Yeah, 100%. The digital tools that we have available today that we did not have back then, we were trying to solve a problem without the right tools.
Yeah.
Right? Like that's the reality. Like all we had was, workflow software and pretty basic UX. But now we have pretty powerful tools that allow us to do really detailed investor segmentation, to really effectively target investor segments in areas that they're interested in, to do it all digitally, to deploy proprietary AI tools into the investor software that allows founders to do the kinds of things we used to train a business analyst to do, and it will take them a day to do. The AI agent can now do in seconds for free, and it's all built into the investment software. And this is the beginning. So the next 12 months is the most exciting phase for the business, because we've kind of gone, we've tested these assumptions. We know that they work. We've built this foundational business. Then we got the benefit of really powerful technology tools over the last 18 months. We've begun to implement those. We've done a first cut of that, and that's kind of cool. We launched our first MVP at South by Southwest last year. We had about 600 founders pile in and start using the first version, right?
Yeah.
And look, I'll be honest, first version isn't great. I mean, it never is, right? It never is. My head of technology once said to me, if the first version isn't embarrassing, you launched too late.
Right.
Which I kind of hate, but I think that's right.
Yeah.
Right. So we put it out there. People are using it. We've got some feedback from some early adopters. That's been super valuable. We've taken all of that feedback and gone, right, let's fix all of these things. And the team has spent the last 6 months doing that. So in the next 3 months, we'll launch version 2, which has the benefit of all of our internal AI tools. And that's, in my view, going to be game changing.
So obviously done is better than perfect in this scenario.
Yeah.
When you first started building out the platform, what was the worst mistake that you made that you learned the biggest lesson from?
I think that the biggest mistake was the way I managed people.
Okay.
I am still working on my imposter syndrome drama, right? And I think a lot of people, hopefully that will resonate, right? Even
relatable. Yes.
Yeah. Yeah. And I love saying it out loud, because I remember the first time somebody I really admired said to me, I just still suffer from imposter syndrome. I'm like, how is that possible? Like, you are my hero. How is this possible? Right. And then you realize, okay, maybe everybody does. And so how do I now balance what I know I can do, right? Because my history teaches me that there's some things that I'm good at, stuff that I'm not. Why do I walk into a room and feel like the dumbest person in the room? Why do I feel like an imposter all the time? So what I did with that, to answer your question, is I would allow people who I would hire to impress me with their CV and not with their execution. And so it would take months and months and months and months. And sometimes I'd have somebody on staff for 12 months before I had the courage to say, you know what, despite all of that stuff that's on paper, you're actually not very good at this, and you need to go, and you need to go. And now, and it's an awful thing to say, but, I think the bottom line is firing people fast is really important.
Oh, yeah.
Hiring slow is important. And then if you have the right fit, right? If there's a value fit, if there's a technical fit, if there's an experience fit, and you like working with each other, that's somebody you should over-invest in. And I think it's taken me a long time to learn that. If I rewind back to the beginning, if I had had that insight then, I reckon we could have saved years.
It's really interesting that you say that. A lot of founders I've spoken to have said that the biggest mistakes they have made is in who they have hired or who they haven't.
Yeah.
Because the team really is everything.
Yeah.
And it's what people bring to it. And particularly at a startup, because you do need people to be working their asses off, and you need them to believe in the vision that you have as a CEO. And if they're not along for the ride, you've got to get rid of them quickly. But our automatic instinct as emotional beings is keep them on, to give them a chance, to see if they can redeem themselves. And I think that that's a lot of the time, a lot of founders' downfall is that they are too emotional, and you have to think, it's not emotional. This is business. And I think a red flag for me is when you're talking to a business and they're like, oh, we're a family here. I don't trust it for a second. Is this a cult?
Well, I mean, I would use that phrase at VentureCrowd. I feel like
everyone is so lovely.
I'm part of a beautiful little family, and I feel personally connected to all those people. But at the same time, I expect those people to do their job and to add value and to contribute, right? And I expect them to expect that from me too, right? And then you want to hire people who you like, who you can feel like you're connected to. I think the family vibe is cool. Like, I don't think that's too daggy to say that. But also...
Yeah, but you can't fire a family member. Do you know what I mean?
You can't fire a family member. But also, I think in our business, we're pretty clear execution is everything, right?
100%.
Execution is everything. So we set a high bar for each other. We support each other to deliver that level of execution every single time. And then we treat each other like a family, which means I've got your back always. But first, execute.
100%.
Right? And then I've got your back always.
Yeah.
And that's sort of worked for us. And what I've found is that culture has kind of spread. It doesn't need to be, you know how they say culture is all led from the top? Yeah, maybe. But what's happening now in VentureCrowd is people self-select each other out. So when we hire, I am the last person to meet that candidate. I want them to go through 2 rounds of interviews first without me.
Yeah.
Right? And if the team says to me, you absolutely have to meet this person, then I'll do it. But if the team says, no, we're not proceeding, I won't even second guess that, because they're the group that's going to have to work with this person at some point.
Right.
And they know what they need from that person.
It's a huge level of trust.
It's a huge level of trust. But the reverse of that is so unhelpful, I think. Like, let's say I meet someone and I'm like, oh, we're going to hire my friend X because we work together and we love each other, right?
I've seen it done.
And you throw them into the group and they're like, who is this loser? Why are they here? Oh, this is the CEO's friend, so we can't say anything. Like, that does not work.
Yeah.
It does not work. So I'd much prefer the team select their own colleagues based on a culture of performance that has just built over time. And, the bottom line is everybody who works at VentureCrowd wants to be part of a winning team.
Yeah.
Right? We are on that same mission together. We genuinely believe that we can make a difference to the entrepreneurial ecosystem by making capital raising easier, by seamlessly connecting issuers and investors with opportunities to create wealth and to make change. Everybody in our business loves that, right?
Yeah.
And every time we have a founder that does really, really well, it can shut down the business for a few hours while Slack explodes with how excited everybody is about, whatever this company that we were involved in funding has gone on to do.
Yeah, absolutely. What advice would you give to founders who are struggling to get their team to come along with their mission and their vision?
Well, I do think it's the role of the founder and the leadership group. I don't think it's just the founder. I think it's really important for your leadership team to be all on the same page. So when I said to you before, it's a team effort, I genuinely mean that. There is absolutely no point me having a vision that even the leadership team doesn't share. So when we build strategy, we have an annual offsite and then a mid-year check-in for the leadership team where we reassess everything: mission, value, strategy, all of the business units, what they're doing, what they'll be prioritizing over the next 6 months. And we just test it all again, right? And it's a bit like, You're standing up in front of your peers, you're running a business unit, and you've got to deliver. How have we performed? If we haven't performed to budget, why not? And what are we going to do to change it? And then it's sort of all gloves are off. It's like, well, you can hear that presentation and be on someone's side and at the same time say, well, that's bullshit.
Yeah.
We know that's not going to work because we've tried that before. So how are we going to do this differently? We're not just going to walk past this discussion. So to your point about how do you get everybody to come on board, I think it's incumbent upon the founder, but also the leadership team to challenge themselves robustly in advance so that when they stand in front of the group and they say, here's what we're proposing, right? What is your view on this? It's as robust as it can possibly be.
Okay. And when you're kind of trying to pick that roadmap to move forward, how do you align priorities amongst, the individuals, the business goals, what's going on with the industry, what's going on with your voice of customer? Where do you get that vision to say, all right, this is where we should be heading? Yeah,
it's a really, really hard, and it evolves all the time, and it literally changes month by month sometimes. But you can't what we've learned is you can't just have knee-jerk reactions to something that might be happening in the market, like crypto.
Yeah.
Right. There was a moment where everybody was saying to me, you're an alternative asset platform and you're not in crypto. What a bunch of losers.
Do you remember NFTs?
Yeah, I do.
Oh my gosh.
I did not get it.
No.
I did not get it. I thought, as long as I don't get it, we're not going to go near it. We're just not going to go near it. I understand venture capital. I understand funds management. I understand property and I understand private credit. Right. And so does my team. So let's focus on our knitting and we'll see what happens, right?
Yeah.
We'll see what happens.
How important do you think it is for platforms like VentureCrowd to offer investors a diverse variety of different investment opportunities and not just access to public investment markets that were previously available?
Yeah. So, we started as a venture capital platform, right? Off the back of the equity crowdfunding legislation. But when we zoomed out, what we realized was happening at a macro level is the public markets were on the decline, and they have been for the last 2 decades, and they are forecast to continue to decline. Companies are staying private, not just longer, but period, which means the public markets now give you exposure to only a fraction of the true investable corporate universe. On the other hand, the private markets have been increasing substantially for the last 2 decades and are forecast to continue to do that.
Okay.
And that is happening off the back of some really powerful fundamental drivers. Largest intergenerational transfer of wealth in modern history, creating a brand new generation of investors who think very differently about what they want to invest in, how, and what they need access to. The digitization of the private capital markets, making access easier. And all of that is driving mass adoption of private market assets, right? And when we looked at that thematic, right, and realized, well, we're in a twin-sided marketplace. Issuers on one side, investors on the other. Do they just want access to invest in private companies that fit the crowdsourced funding regime, which we're a big fan of, by the way, has a very important role to play. But that was not enough.
Yeah, right.
What that new generation of investor wants, in our view, is access to a diversified asset mix. So we expanded from just retail crowdfunding to all sorts of venture capital, right? To property, to private credit, and in managed funds, because we just didn't feel as though boxing ourselves into just crowdsourced funding was solving a real problem for investors in particular.
Right. It's an interesting perspective to consider because equity crowdfunding in Australia is such a relatively new concept. Only started in 2018, the industry here, and we can learn a lot from how it's performed in the US and the UK.
Yeah.
And whilst it is such an interesting market for investors who can get in at such a small amount of capital and at such an early stage, it is pretty high risk, and you are placing, it's a big bet, but at the end of the day, there are potential high returns. There's been some incredible outcomes for investors in the UK, that's for sure. If you look at Monzo or Revolut, massive returns came through, but you are running a risk. I recently spoke to Adrian Bunter from Sydney Angels, and what was really interesting to learn from him is when they have done sidecar funds in the past, a lot of the time they're hedging their bets on one or two companies, making enough return to pay for the companies that don't do well. How do you feel like that has come out in your past experience when you've been, promoting a lot of opportunities on the platform and knowing that some of them will fail?
Yeah, sure. I mean, our view has always been simply to provide a fair level of information that allows people to make an informed decision and to allow them to participate on the same economic terms as a lead investor.
Right.
That is no different to a VC fund doing its due diligence and then handing that same deal to another VC fund and saying, do you want to participate? Yeah. It's the same thing. All we're doing is saying, in exactly that same scenario, what if everybody could participate? Yeah. Right? So, the kind of deal flow we tend to focus on, we believe is as good as anything that an angel group is going to see or a VC fund is going to see, right? The only difference is we make it available to as many people as we possibly can. Right. So on the issue of diversification and risk, it's absolutely true that investing in private companies at the earliest possible stages is a high risk, high return proposition. And as they develop their business and begin to de-risk aspects of their business and begin to grow, create revenue, reach, cash flow positivity and then growth, then that risk drops. It is also true that level of return that's available from your Monzos and your, Clarity Pharmaceuticals and so on is only available by investing in private companies that are in those early stages of growth. So the approach I personally take is this makes sense. Investing in early stage companies makes sense as part of a diversified portfolio and should always be seen like that. Totally. It's as simple as that.
So VentureCrowd has recently just done a partnership with Sydney Angels, which you've been involved with for quite some time. Yeah. How did that come about, and why is it important for VentureCrowd to be doing those kinds of partnerships with funds?
Yeah, so I have a soft spot for Sydney Angels. I was on the management committee of Sydney Angels for a long time when I was at PwC. And in fact, the Sydney Angel Cycle Fund 1 was the very first venture fund I ever set up. Oh, wow. So I have a real soft spot for the organisation and what they do and the work that they do. So when we were approached to take on Sidecar Fund 3, I was thrilled to be able to participate, right? Sidecar Fund 3 is a really interesting concept because on the one hand, we were talking before about the growing number of people who are prepared to pick and choose deal flow and to select private companies that suit what they want to invest in. Now, you can already do that on the VentureCrowd platform if you're inclined to do that. Sure. But there are significantly greater volumes of people who don't want to do that, but do want access to the asset class. For sure. And this fund is designed exactly for that investor demand, right? Yeah. So it gives you private exclusive access to a curated portfolio of high growth startups that have been assessed and invested in by a Sydney Angel syndicate following an investment process that they've been curating and fixing and refining over a decade into a fund which is tax-free, which also gives you a 10% tax offset up front for a minimum investment size of $25,000, called over 5 years in 5 equal tranches, done digitally. Like there is nothing else in the market that facilitates this. That essentially means you can invest in a venture capital fund which is tax-free and has all of those benefits for $5,000 up front. It's unheard of. And when I spoke to people about this, they basically said, most of the people in my network said, that is insane. Do not do it. Why would you, literally, why would you bother with an investor for $5,000? And I am so deeply offended by those kinds of statements. I'm like, what makes that investor any less worthy of this opportunity than someone who's prepared to drop $500,000? I just don't buy it. Now, I totally understand that in the traditional private capital markets, the cost to serve an investor is so high that you can't really accommodate a client who wants to put in $5,000. But because we're digital, our cost to serve is really, really low. So it's really easy for us to syndicate hundreds, maybe thousands of people who are putting in 5,000, 25,000, 50,000, whatever. And all of a sudden you've got this massive pool of capital that is not competitive with traditional forms of early stage capital funding, but accretive too.
Yeah.
Capital that never would have been there, right? And for all those reasons, the Sydney Angels Psycho Fund, Sydney Angels itself, coupled with the work we do, the strengths of VentureCrowd, it just plays really, really beautifully together. And we've seen that resonate really well. The first tranche closed in 3 hours of launch. And then within a week of launch, it had raised 400% above its target. Now, tranche one's closed, tranche two waitlist has opened, and there's a lot of demand. So, you know, my sense is the market wants to participate, and it is incumbent upon organisations like us to facilitate that participation.
For sure. And why are funds like this so important to supporting the next generation of founders in the Australian startup ecosystem?
I'll give you an example, right? So a couple of years ago, we were approached by two ex-CSIRO scientists, geniuses, right? And they were working on a cancer therapeutic, which could be administered into, and I'm going to stuff this up because I'm not a scientist, but basically could be administered into sort of a nanocell and then administered directly into the body to specifically target really aggressive cancer like pancreatic cancer.
Wow.
Early results were really strong, but they were literally running out of money after approaching all of the usual investors. And they came to us and said, you know, could we do a raise? And if I'm honest, I was not sure if it was going to work. We're a digital investment platform. Everything we do is digital. So would really complex, deep intellectual property like cancer therapy translate in a digital environment? I just wasn't sure. But because it was cancer and because it was important, we gave it a shot. Within the first 4 weeks of that campaign, they had raised $1 million. And they said, and I said, well, what do you want to do? My suggestion is you keep this open because there's lots of momentum. It then went to 2, then it went to 3, then it went to 4. And then when it hit $5 million, they asked us to close the campaign.
Wow.
Okay. They were literally running out of cash. A few months ago, we got the results of their first US trial where a woman who had late stage pancreatic cancer was given months to live, was allowed to use this trial drug under the FDA's compassionate right to try regime. And I'm getting goosebumps.
Cheery.
Yeah. And I mean, you know where this story is going, right?
Yeah.
Like, so she used the drug under the right to try regime. She is now 2 years cancer free.
Oh wow!
And it's the only report of late stage pancreatic cancer patient making a full recovery.
Wow! From
innovation, made in Australia, funded by the crowd, digitally. Right. So there is something in this. And I know that when we got that report, we were, I was talking before about how the family sort of shuts down when we have a massive win. That was a massive win for us.
Yeah.
Slack was just blowing up when we got this news because everybody was so excited that they had been a small part in facilitating hundreds of new investors to find their way into a company that just saved a life. Now, maybe that's just one life, but is it ever just one life?
Do you think it's crazy that if it wasn't for you, and I'm like just being like quite specific, if it wasn't for you pushing to have the VentureCrowd platform, and if they didn't find you and the VentureCrowd platform to actually raise this capital and be able to continue doing their research and creating this product, that woman might not have survived.
I mean,
Isn't that crazy?
Yeah, it's crazy. I just think that's the power of the crowd.
Yeah.
I really do think it's the power of the crowd.
And people forget that. And it's interesting. It goes back to what you were saying before about how people minimize somebody as an investor because they might be a small investor, but they also become an ambassador for the company.
100%.
Because they're pushing for it to succeed.
100%. And when it comes to retail crowdfunding, for example, where it's a consumer-based product where the majority of people can understand, it becomes even more powerful.
100%.
I know from, I have family members send me photos of their kids holding Nextbar bottles when they release a new flavor. Like, oh, we love the new raspberry such and such, right? Like
Love
you've
that.
literally got these people who have paid you, right? Because they've invested in your company to be your ambassadors.
Yeah.
Like it's just the power of that, that whole building a brand community. There is no more powerful way to build brand community than to allow people to become a shareholder in your company. Because what aligns you more with your customer than I'm actually an owner in this? I want you to succeed, not just because I enjoy raspberry kombucha, but because I'm a shareholder. Now, I may only hold 2 or 3 shares, but I'm a shareholder. So, the next time I go to a kid's sports match or I'm at a barbecue, I'm going to buy Nextbar because I'm a shareholder. Right? That matters.
Exactly.
And it's really hard for brands. The best brands in the world have managed to build brand community, the best brands in the world. And it is incredibly difficult to do. You cannot buy it. You have to earn it. Right. And I actually think retail crowdfunding is the best way to do it.
Yeah, for sure. In terms of industry trends for retail crowdfunding and what people will be investing in the future, I mean, if you look back, there was that big boom of breweries. If you recall, that was a time. And then there was a big boom for medicinal cannabis.
Yeah.
What do you think we can expect to see in the next year or so?
I don't know.
Really?
I don't know. And I say that with all of the confidence in the world, imposter syndrome aside, because there are a number of elements at play. I can't predict what innovators are going to do next. And I don't think anybody has ever been able to predict what the innovators are going to do next. That's the first thing. So I don't know what's going to be on offer. But I'm confident that it'll be special, right? No, because the entrepreneurial ecosystem has always delivered stuff which has blown us away.
Yeah.
That has made us great creatives, amazing entrepreneurs, amazing technology teams have come up with stuff where we've just gone, that is excellent. And I want to back it.
Yeah.
Then as for who's going to back it, well, that's not my call either. Right? All we do is facilitate the ability for as many people as possible to participate in that deal alongside the lead investor on exactly the same economic terms. And I don't know how it's going to go because it's a crowd decision and it's not mine. And so whenever we do sort of internal running the ruler over things, I always try to get the team not to apply their own personal investment lens to it, but to simply be objective about, does this have a lead investor? Does it otherwise meet our core due diligence criteria? The question is not, would I invest in it? Right? That's a matter for the market to decide.
Absolutely. I think it's interesting how there's different industry sectors that are interesting for a retail sector. And then you look at what wholesale investors are looking at, and a lot of wholesale investors currently are looking at AI businesses.
Yeah.
Why do you think that is?
Well, there's very, very good reasons for that, right? I was talking before about the first version of our technology and how it was so clunky, right? It was basically workflow software, which is not very unique and can be easily replicable, right? But what AI has allowed us to do is to replace some of the most complex parts of the capital raising process that previously required highly trained business analysts to do in seconds for free. And that's us. And that's in a highly regulated, quite complex investment process, which has a number of different stakeholders, from the regulator to the investor to the platform to the founder itself, and can be, incredibly nuanced, from ordinary shares to preference shares to convertible notes to debt instruments to properties to mortgages to this to that. And still, we can teach, and we have, right, internal proprietary AI agents to take 10 years worth of VentureCrowd's campaign data and collateral, right, and apply it to these campaigns so that a founder, for example, can literally have it run alongside their campaign automatically.
That's so cool.
It's extraordinary. The power of AI in the investment markets and the private capital markets, I think, cannot be underestimated. 12 months from now, we're not going to know ourselves. And what we're building right now is so AI heavy because it is such a powerful tool in cracking some of these really complex parts of the process. we've appointed a new advisory board member who is the head of AI for Optus, formerly at Combank, Jesse Arundel, to help guide our internal technology team as we build out agentic AI throughout our entire process. So we're super excited about it. And that's just the business I know really well, right? Agentic AI across industries is going to completely change the way things work.
For sure.
So I can understand why people are excited about this. It's a form of technology that I think we're only really just starting to scratch the surface. So
absolutely. And then if you look at the property sector of the platform, there's a lot of emphasis on Queensland-based properties. Why is that?
Because we love Queensland. We formed the view a little while back that Southeast Queensland was a solid market. Southeast Queensland right now is the hottest property market in the country. Brisbane has replaced Melbourne as the second most expensive city in the country. The Gold Coast, prices in the Gold Coast over the last 5 years have nearly doubled in 5 years. In Toowoomba, which is 2 hours out west of Brisbane, it's Australia's second largest city. And see the way you're nodding, nobody knows where that is, right?
I've definitely heard of it. I've heard of it.
No,
that's for sure.
But Toowoomba property prices have gone up 71% in the last 5 years. And, it's got a brand new airport. It's got an incredible amount of local infrastructure being pumped into it. The population is growing at a rapid rate. The economic growth of the area is insane. So Southeast Queensland is really, really powerful. The Gold Coast is particularly interesting.
Yeah. Okay.
So yes, we've been very bullish on the Southeast Queensland property market for some time. We've got a number of different projects that we're invested in, everything from large land subdivisions in Toowoomba, 314 land lots in Glenvar, which is just outside Toowoomba, to luxury boutique residential estates in Carrara, which is just 8 kilometres out of Broadbeach, with views of Broadbeach on one side and the Surfers Paradise skyline on the other. So what we do in property is we enable investors to participate in every part of the capital stack. So we'll package up the funding for the equity component right up front at the beginning of a project. Then we'll package up the mezzanine debt or preference equity component in the middle. And then we'll package up the first mortgage component for construction at the end. Now, obviously, as the project develops, the risk drops and the return drops, right? So our equity products have earned in the past anywhere from 30 to 40%. The mezzanine product somewhere between sort of 18 and 20 is about right now, with on like a second mortgage type security, and then first mortgage products in the sort of early teens up to about sort of 12 or 13%. So the property part of the business is designed to facilitate additional diversification for as many investors as possible into whatever part of the capital stack they feel comfortable with. And what we tend to find is investors typically back a project, like they might back the Carrara project on the Gold Coast because that's a growth story that makes sense to them. And then they'll typically invest in every part of that capital stack. And that's something there's no other way you can do that. Right? So
there's some terminology that might be a bit unfamiliar to people who are listening, such as mezzanine facilities or second mortgages. Could you explain how that works in a little bit more detail?
Yeah. So, a property project is no different to a startup, right? It starts from a piece of paper and an idea, and then it moves through an approvals process, and then it moves through the construction of the civil works, which is, all of the roads and the pipes and all those things that happen under the ground that you can't necessarily see. And then dwelling construction happens on top of that.
Okay.
And then it gets sold, right? Obviously. So everything from it starts as a piece of paper to there's a whole bunch of things built that are ready to be sold is, if you like, the life cycle of a property project in the same way as a startup. Right at the beginning, investors are taking the largest risk because nothing's been built yet, right? They're taking a risk that, will this property obtain the necessary approvals that it needs? Will this property be able to facilitate the civil construction that it needs? And then so on and so on. Equity risk, I think, is pretty obvious. You become an owner in the final project profit, and you take a share of that project profit. High risk, high return proposition, but it can be quite lucrative. After the equity component has gone in, that's typically when the property has been acquired, approvals have been obtained, and usually the beginning of the civil work has started to go in, the roads and things. At that point, the next tranche of funding is typically called mezzanine debt.
Okay.
It is a loan that's made by a fund or a group of people to the project, and the return on that is typically sort of 18 to 20%, but it gets repaid back after the first mortgage provider. So at the end of a project, when everything is sold, first mortgage provider gets paid back its loan first. The mezzanine debt gets paid back second, which is why it takes a second mortgage.
Right.
So the risk there, of course, is that something goes wrong, it takes too long, it doesn't generate the level of profit necessary to repay the first mortgage. And then, of course, you've got an impairment of the mezzanine debt.
Okay.
That's the risk that you take. Now, you can usually assess the likelihood of something like that right up front by looking at the feasibility and trying to work out whether there's enough fat in those profit numbers to accommodate likelihood of those very normal risks that every property project goes through. Rain, delay, whatever.
So how are platforms like VentureCrowd actually giving investors, that insight and the knowledge that they need to make a smart investment and know where their money's going and know the risks that they're, actually going to be taking on? Yeah.
So our property team is headed by a guy called David Whitting. He is the former general manager of Growcon and Multiplex for Queensland. So a very senior property development person. Our development management teams are sort of ex-Mirvac, ex-AV Jennings, top end of town pedigree in the delivery of these kinds of projects. So when we put together an information memorandum and a feasibility, we do a level of due diligence over that feasibility and its supporting documentation that is, it's institutional grade as far as we're concerned. So, that's the same information memorandum we would put in front of a institutional provider putting $50 million in as we would to, an investor putting in $25,000. That's how we get comfortable with providing the right level of disclosure for an investor to be able to make an informed decision. And again, it goes back to that whole idea of all we're doing is inviting you to participate on the same economic terms as everybody else. It's not like our institutional investors are getting significantly more information than everybody else. It's all in the IM and you can ask for whatever you want. So that's kind of how we treat the disclosure process.
Yeah, I love it.
Yeah.
So from a perspective of, obviously it's a two-sided marketplace. There are two customer sectors for a platform like VentureCrowd. You've got your founders and you've got your investors. So looking at it from a founder perspective, what do you think is the hardest part about raising capital?
Where do we start? I mean, every part of it is hard. You don't we went back to, we talked earlier about the inefficiency of the private capital markets, right? And the fragmentation of it. There are hundreds of groups around who are investing in early stage stuff, but how do you find them? There are hundreds of angel groups. There are hundreds of VC firms. They're all at different sizes. There's lots of different family offices. They all have different mandates. They all have different terms of engagement. And then you've got to, even if you can work out whether those terms of engagement and those mandates suit the kind of business that you are running, then you've got to try to get access, right? Investment committee composition can vary between groups, right? You don't know whether you're going to get somebody on the other side of the table who really understands your sector, in which case they're going to get the problem pretty quickly, or whether you're going to get somebody who happens to be an infrastructure person who doesn't understand med tech at all. And so, their response to you is going to be something like, you're to this or you're to that or whatever. Most of that response is going to have nothing at all to do with you and your business, but everything to do with the fact that the fit doesn't work, right? And then there's unconscious bias, right? We do have a view about what a traditional founder should look like and sound like and be like.
Yeah.
And I think that's bullshit, right? I think at the end of the day, some of the most impressive people I have ever met have been the antithesis of what we expect of a traditional founder. They're not extroverts. They're not the loudest person in the room. They're just really great at what they do, and they deserve to be backed because they could genuinely change the planet.
100%.
So yeah, I think it's really, really hard for founders. And, by digitizing the process, we're trying to take a lot of that bias out of it, right? Because, you don't need to be the loudest person in the room. It doesn't matter anymore in a digital environment, So yeah, I think capital raising is, it remains very, very complex. It remains very, very difficult. It's very inefficient. It's slow and it's cumbersome. And I think the biggest problem with capital raising is that we have somehow convinced the market, we've somehow convinced entrepreneurs that all of the best deals get funded. And I just don't believe that. The bottom line is, there are lots of great companies that do not get funded. And that is because the private capital markets have particular kinds of mandates, and that's perfectly fine. But just because you don't fit those mandates doesn't make you a bad company or a company that's not investable. All it means is you haven't found the right fit. So what we're trying to do is say all of those traditional sources of capital should remain as they are and continue to grow as they have over the last decade. And that's brilliant. And in addition to that, let's open it up digitally to as many people as possible who want to participate in increasing the pool of capital available to great founders who are doing great work.
Absolutely. I think we could leave it there. I mean, I could talk to you all day about this, and it's so nice to hear your passion come through for not only investors, but for founders and for what you're building with VentureCrowd. And I know a lot of people have you to thank for the success of their businesses, and it's incredible to see the impact that you're making in the startup ecosystem in Australia. So thank you for everything you do out there, and thank you for coming in here and speaking with me and sharing your story. I really appreciate it.
It's such a pleasure. That's so kind. I'm not taking any of that credit, but thank you so much.
Of course you're not. Of course you're not. But thanks so much, Steve.
Thanks, Emily.